welcome everyone. Maybe we can take this slide off. Terrific. Welcome everyone. We're excited to have you be a part of our webinar on research opportunities concerning the FASB's new revenue recognition standard, Topic 606. I'm Jeff Mechanic. I'm one of the assistant technical directors here at the FASB, and I'll be your moderator for this session. Let our presenters introduce themselves, starting with Christine Bodison.
Thanks, Jeff. I'm very pleased that you're all able to join us today. I'm Christine Bodison, and I've been a board member since 2016. And I'll turn it over to Lucy next.
Thanks, Christine. Good morning or good afternoon, everyone. I'm the project manager, and my name is Lucy Chen. I'm working on the revenue PIR process with Mary. Now, lead to Mary.
Thanks, Lucy. Hi, I'm Mary Mazzella. I'm Assistant Director on Revenue Recognition and have been working on the project since the standard was issued in 2014.
And I'm Shannon Garvalia. I'm the postdoctoral fellow, and I'm going to send out a link in the chat box to the slides for today's presentation if you'd like to download them and follow along.
And as we're loading up those slides, let me give a shout out to Joy Tsai, who's a supervising project manager at the FASB, and to Alec Mulatto, who is a postgraduate technical assistant. Joy and Alec are in the background helping us with this webinar, and thank you guys. So move along. Pictures of all the folks you've just met. And let me now talk about what we're going to be discussing today. First, Christine is going to talk about the objective of the session and provide an overview of the FASB's post-implementation review process. Then we'll dive into the revenue recognition standard, beginning with the problem that we were trying to solve and the general solution that we came up with. Lucy Cheng and Shannon Garavalia will be talking about that and talking about the research opportunities around those types of general questions. Then we'll dive into specific topical areas, and a combination of Mary Mazzella, Shannon, and Christine will talk about those areas, provide an overview of those areas, as well as research questions connected with those areas. And then finally, we'll talk a bit about the disclosures, with Mary providing an overview and Shannon talking about the research opportunities having to do with disclosures. And then finally, Shannon will talk about upcoming future educational opportunities, including our upcoming webinars on other areas for research, specifically the one we're doing next Friday on the new credit losses standard, as well as an important webinar we'll be hosting a little later this spring on pulling XBRL data. Let's move on to the next slide. A few housekeeping items for you. First, CPE is not available for this particular webcast, so you won't have any pesky polling questions, say that 5 times fast, every 10 or 15 minutes. To ask a question during the session, please use the Q&A feature, not the chat feature. If you use the Q&A feature, that will help ensure that I and the presenters are able to see all of your questions. And we'll be stopping at the end of each section to see what questions have come in, as well as we'll have a catch-all time at the end of the session to answer any remaining questions. Slides are available for downloading on our website at our academic landing page, which is indicated here. And Shannon also posted this link in the chat box. Let's move on to the next slide. We will be archiving a recording of this webcast in case you would like to re-listen to this or point any of your colleagues to listening to this. That will be available on our academic landing page, at least for the next several months. It'll also be available at the Accounting for an Ever-Changing World website, and we've provided the link here. And if you have any questions about this webcast or any of our other educational webcasts, and we do have various other educational webcasts during the year, including ones aimed at academics, please contact Shannon, who's our postdoctoral fellow at academics@fasb.org. So with that, I'm going to turn it over to Christine, who's going to go over give you an overview of the session and an overview of our PIR process.
Thanks, Jeff. Appreciate that. We can just go directly to the next slide. Thank you. So our objectives for this session are to provide an overview of the FASB's post-implementation review process and the role that academic research plays in PIR. We're also going to go over certain aspects of the revenue standard, and we would welcome any questions that you have about the guidance. Finally, we're going to highlight areas of opportunity for academic research that is relevant to the PIR of the revenue standard. But it's not our intention to provide explicit research questions or to recommend particular research methodologies. Instead, what we'll be doing today is sharing some of the questions that we're interested in understanding better. Certainly not a comprehensive list, but just some of the questions that we're interested in, with the hopes that it might help you to identify research questions that would be of interest not only to the FASB, but also to the academic community. Next slide. Thanks. Post-implementation review is the process that we use to evaluate whether a standard like the revenue standard is achieving its stated objectives in a cost-effective manner. Academic research is essential to that post-implementation review evaluation. PIR has three major objectives. The first one is to determine whether the standard is accomplishing its stated purpose. And in that respect, we look to whether the standard resolved the issues that underlay the need for the standard in the first place. We also assess whether the standard is yielding decision useful information for the users of financial statements. We also consider whether the standard is operational, resulted in any significant unexpected changes to financial reporting or operating practices, as well as whether there were any significant unanticipated consequences that resulted from the standard. The second objective is to evaluate the cost of implementing and complying with the standard on an ongoing basis. And the last objective is to provide feedback on the standard setting process itself and to identify areas where we can improve that process. And of course, academic research related to any of these objectives would be welcome. Next slide. Thank you. Post-implementation reviews on the standards on leases and credit losses are also underway in addition to the post-implementation of the revenue standard. There's information on our website pertaining to all of those post-implementation review projects, and embedded on this slide are links to those areas of our website. Jeff already mentioned, but I'll just repeat that we did recently have an academic webinar similar to this one on the leases post-implementation review. And a recording of that webinar is available on our website, and the link is provided there. We also have the upcoming academic webinar on credit losses, and registration is already open for that March 26th session. Next slide, thank you. Because academic research is so important to our post-implementation review process, the FASB is working with the ISB, the Accounting Review, and the AAA on the Accounting for an Ever-Changing World Conference. That conference is going to be held in November of 2022. The submission deadline for the conference is in May of 2022. And there is a link to the conference homepage on this slide if you'd like to learn additional information about the conference. But the conference is being held to promote research that is relevant to the post-implementation review projects that both the FASB and the ISB currently have underway on revenue, leases, and financial instruments. So we're very hopeful that today's session will provide some food for thought about topics that would be relevant to the standard setting process and to the post-implementation review of these standards. And with that, I'll just turn things back to Jeff.
Yeah, it doesn't appear that we have any questions yet. I don't think any of you guys see, I don't think so. But so with that, let me turn it over to Lucy Cheng, who's going to provide us with an overview of what we were trying to achieve with the new revenue recognition standard.
Yeah, great. Thanks, Jeff. So now let's take a look at together the purpose and main provisions of the new revenue guidance in the next few slides. So moving on to slide 13. Yeah, so this slide, the new revenue guidance is the result of the FASB's and ISB's joint project to improve the financial reporting of revenue under both US GAAP and IFRS. Previous revenue guidance under US GAAP comprised broad revenue recognition concepts together with numerous prescriptive requirements for particular industries or transactions. This resulted in different accounting for economically similar transactions. Over the years, the volume of revenue guidance increased significantly, and some of the guidance had different conceptual underpinnings, which led to inconsistency and complexity. Despite the guidance, there was a noted absence of guidance for some areas, for example, services. In contrast, IFRS provided limited principle-based guidance and were sometimes difficult to understand and apply to complex transactions. Additionally, there was a lack of guidance on important topics such as revenue recognition for multiple element arrangements. Consequently, some entities that were applying IFRS referred to parts of US GAAP to develop their revenue accounting policy. In addition, the disclosures required under both US GAAP and IFRS were limited and generic and not very useful for financial statement users. While some entities voluntarily disclosed some information usually outside the financial statements, users informed the boards that better disclosures were needed. As a result of the two boards' joint efforts, the new revenue standard was issued in 2014 to clarify the principles for recognizing revenue and to develop a common revenue standard for US GAAP and IFRS. Now moving on to next slide. Let's take a look at the expected improvements of the new revenue guidance. First, it introduces a comprehensive framework for addressing revenue recognition questions when they arise. As business models change, new products and services are developed, and economic conditions fluctuate. Establishing an overarching model under the new guidance is more sustainable than the approach on the previous guidance, whereby practice sometimes struggled significantly with revenue accounting for new types of arrangements. It also addresses the problem with either the prescriptive or inconsistent guidance for certain areas or the lack of guidance for other areas. Second, the new guidance is expected to improve comparability of revenue recognition practices across entities, industries, jurisdictions, and capital markets. The boards expected to benefit users and in the long term, reduce cost. Third, the new guidance enhances disclosures to help users better understand the nature, amount, timing, and uncertainty of revenue. As the staff recently learned during the user outreach, the disclosures under the new guidance provide them with more information about the contracts and the context on the revenue number recognized. So now let's move on to the next slide to take a look at the model. The core principle of this model is that an entity recognizes revenue to depict the transfer of promised goods or services to customers for the amount that it expects to be entitled to. To apply this principle, an entity follows the 5 steps analysis. These steps provide a logical process for working through a revenue transaction to determine when and how revenue should be recognized. Now, let's quickly walk through these steps for a company that enters into contracts with its customers. The company first identifies the contract or a combination of contracts to which it applies the revenue guidance. This step includes the identification of the rights of the parties and the payment terms, the assessment on the commitment of the parties, and the evaluation of the commercial substances of contract and the collectability of the consideration. This step also provides guidance on how to account for contract modification. Moving on to step 2, the company needs to identify the performance obligation, which is the promise in a contract with a customer to transfer a good or service. If the company promises to transfer more than one good or service to its customer, it should account for each promised good or service as a performance obligation, only if it is distinct or it is a series of distinct goods or services that are substantially the same and have the same pattern of transfer. The new guidance further provides criteria to assess if a good or service is distinct. In step 3, the company determines the transaction price, which is the amount of consideration to which it expects to be entitled. To determine the transaction price, the company should consider the effects of variable consideration and its constraints, the existence of a significant financing component, non-cash consideration, and consideration payable to the customer. During the PIR outreach, the staff learned that this is one of the areas that expose some challenges in practice, so Mary will have a more in-depth discussion on this area later. In step 4, the company allocates the transaction price determined in step 3 to the performance obligations identified in step 2. This allocation is normally done on a relative standalone selling price basis. Sometimes, the transaction price includes a discount or variable consideration. The new guidance explains how an entity should allocate the discount or variable consideration to the performance obligations in the contract. Finally, in step 5, the company recognizes revenue when it satisfies a performance obligation. This occurs when the customer obtains control of the promised good or service. The company should determine whether it satisfies each performance obligation over time. If not, then the performance obligation is satisfied at a point in time. The new guidance also provides criteria for this assessment. So that basically concludes our overview of the new revenue guidance. Now I turn it over back to Jeff.
Okay, and it looks like I think we have one question to see if anyone is able to answer that now. Otherwise, we can answer it very shortly at our next break.
So, okay. Yeah. I think Mary.
I can take this one. Yeah, so it really does vary. There were some, and the question was if there were particular industries that were impacted by the change in the revenue model. And rather than maybe discussing specific industries, I'll just note that, broadly, the industries that were the most impacted were those that had specific guidance, industry-specific guidance that were moving to the broader model is where we see some of the bigger changes. Later in the presentation, I'll talk about licenses of IP, and that was one of the more significant changes. But I think that's, when we look at trends, that's where we see some of the biggest impacts.
Mm-hmm.
Okay, terrific, Mary, thank you. So let me turn it over to Shannon, who's going to talk about related research opportunities on the broad aspects of the revenue recognition standard.
Thanks, Jeff, and thanks to Lucy for that great overview of kind of where the standard came from and some of the key details of the standard. As we talk about related areas for research, everything will kind of fit into this umbrella of whether the standard is accomplishing its stated purpose, in line with Christine, her overview of the PIR process at the beginning of the presentation. And within that, we're going to break things down into several sub-questions, which again kind of all tie back to the objectives of the PIR process. So first and foremost, the question is whether decision useful information is being reported to and used by investors, creditors, and other users of financial statements. And as that pertains to topic 606 specifically, we wonder if the decision usefulness of information about revenue from contracts with customers has improved. And not only that, but has it improved, does it vary by the type of user? So again, as Lucy mentioned, this is a converged standard. So we could look at differences across groups like international versus domestic investors, or other groups like differences across equity versus credit investors, buy side versus sell side, et cetera. And then again, given it's a converged standard, we're interested in whether the comparability of information has improved not only across entities and industries, but as well across jurisdictions. And then last, what was the nature and magnitude of any revenue adjustments, and did users react to these adjustments? So for example, were there positive revenue adjustments that were made, and did users react to those adjustments, or did they back them out because they felt that they were simply a result of a change in the accounting standard? Next slide. The next sub-question that we'll focus on is whether the standard is operational. And so here, first and foremost, we wonder what's the nature, magnitude, and drivers of both implementation and ongoing costs related to Topic 606. And I'm sure we have some audit researchers out there in the audience today. So this would be a great place to kind of look at how have auditors faced any operational challenges related to Topic 606, and is the guidance sufficiently clear to help them as they go through their processes, in addition to any challenges faced by preparers. And then again, as Lucy mentioned, this is a 5-step judgment and decision-making model with a little bit of emphasis there on the judgment piece. So it's ultimately still subject to management's judgment. So how reliable and unbiased are estimates that are based on management's judgment as a result of the new guidance under Topic 606? Our next sub-question is whether there have been significant unexpected changes to financial reporting or operating practices that have resulted from the standard. And here we wonder, have there been changes in efficiency between accounting and operations departments? And then as well, has the guidance complicated the analysis of accounting for certain transactions? And as Mary and Lucy kind of alluded to, we're going to get into some specific topics where we think there might be some questions that are relevant here. But if there are other ones that we don't speak to today, like Christine said at the beginning of the presentation, that doesn't mean we are not interested. Please investigate those questions and share your results. And then last, is the 5-step model a useful judgment and decision-making tool for making revenue recognition assessments? I know I'm an experimental researcher, so I hear judgment and decision-making tool, and I think that sounds like a great thing for experimental researchers to look at, those of us who do judgment and decision-making research. Next slide. The final question that we have is whether there have been significant unanticipated consequences that have resulted from applying the standard. And so as it pertains to Topic 606, we wonder if there's been an impact on any contracting practices. For example, have there been systematic changes to contract terms? Have firms strategically changed their product offerings or pricing structures or delivery terms, all as a result of the guidance under 606? And then again, has the alignment between revenue recognition and economics in certain industries or sectors changed? So Lucy mentioned that prior to 606, there was a lot of divergence because of differences across industries and industry-specific guidance. And so one goal was to kind of increase the alignment. So have we actually seen an increase in the alignment between revenue recognition and economics across industries and sectors? And with that, I'm going to turn it back to Jeff for some additional Q&A.
Yeah, and it looks like we have a question or two, and I know Lucy, you wanted to answer at least one of those.
Yeah, sure. I start with the questions for the private companies. There's 2 related questions. So the question is the private company expect to follow the exact 5-step prescribed here? So basically, we think, as I mentioned before, we think this 5-step is a logical process. So we encourage the companies to start with step 1. I think step 1 is critical, especially how do you identify a contract? How do you identify who is your customers? We think that's an important starting point. And I will also acknowledge that in the practice, especially for some private companies, they might have the consideration on from step 2 through 5 collectively. But when you end up at step 5, then you have some challenges, or there's some inconsistency with your understanding, then you might want to go back to step 2 or even step 1 to reanalyze. So we encourage the 5-step step by step, but we also acknowledge there's a collective consideration there. So I don't know, Mary, if there's anything else you want to add on this question?
I think you covered that one well. I think I was going to answer, there was another question that came in about comparability. So the question was, could you talk a little bit more about what you mean by improved comparability in this context? Are there specific examples of areas where similar transactions are being accounted for differently, or different transactions being accounted for similarly under old guidance that would be improved under 606? And I think for the comparability, we look at it from a couple of different aspects. At the highest level, having a common model that all companies are applying both in the US and internationally under IFRS provides a common starting point to analyze transactions. So when a financial statement user picks up a set of financials, they can understand the process a company is going through to understand the revenue recognition. It provides comparability across industries because, as we had noted on a prior slide, there were certain industries that had different revenue recognition practices. So, differences in industry-specific guidance could lead to differences in timing or of recognition, differences in measurement methods. So having that all on a common platform now should improve the comparability there as well. So those are kind of the two main aspects, but I think that the comparability kind of percolates through various aspects of the standard.
Thanks, Mary. Lucy, I think there's another question that you'd like to answer.
Yes, this question is about the alignment between revenue recognition and economics, and what economics are we referring to? Actually, this is an interesting point that we heard from some users during our outreach. The users' concern is for certain industries like licensing software, their view of economics is not consistent with the revenue recognition timing. So I think that's one of the areas Mary will talk in depth on this area. So it's more like from whose perspective the economics is viewed. I think that's one of the area we would like to understand. And also, like, some users just use cash flow as the representative pattern of the economics. I think that's also an interesting point, that because accounting is on an accrual basis, not on a cash basis. So we also want to see, like, from the academic perspective, how do you view the economics, and from your research and analysis, how that aligns with the revenue recognition pattern?
Thanks, Lucy. I don't see any other questions at this time, so I'm going to turn it over to Mary, who is going to start us in our deeper dive on specific topics.
Thanks, Jeff. So in this next session of the presentation, I'll discuss some of the technical aspects of topic 606, and then Christine is going to take us through some potential research opportunities related to those topics. So moving to the next slide on determining the transaction price. As Lucy had discussed earlier, there are 5 steps in the new revenue recognition model. I am going to focus on one of those steps, determining the transaction price, which is step 3 of the revenue model. This is an important step in the revenue recognition model because the transaction price is the amount that a company allocates to the performance obligations in a contract and ultimately recognizes as revenue. This aspect of the model contains some significant changes as compared to topic 605. First, the guidance introduces the concept of variable consideration. That is, there is no longer a requirement that the amount of consideration be fixed and determinable in order to recognize revenue. Step 3 also introduces the concept of a significant financing component, which may require entities to recognize interest income or interest expense in some cases. There is also new guidance on how and when to measure non-cash consideration. For example, consider a revenue contract that is paid for with a company's stock. And lastly, some clarifications were made to the guidance on consideration payable to a customer, which is commonly referred to as sales incentives. So on this next slide, I'll dive a little bit deeper into the variable consideration guidance specifically. In contracts with customers where the promised consideration is variable, a company needs to estimate the amount of consideration to which the company expects to be entitled. The guidance specifies that a company should estimate variable consideration using either the expected value or the most likely amount method, depending on which method the company expects will better predict the amount of consideration to which the company will be entitled. This is not intended to be a free choice between the methods. Rather, a company needs to consider which method it expects to better predict the amount of consideration to which it will be entitled to, and apply that method consistently to similar types of contracts. For example, consider a scenario where a company provides a consulting service to improve a customer's manufacturing process. The contract does not include stated fixed consideration for the consulting service, but rather, if the customer's manufacturing costs decrease by 5% over a 1-year period, the company will receive $50,000 for the consulting service. In this case, the company would generally use the most likely method because it will get 50,000 or nothing. In contrast, if the scenario included a range of outcomes, such as an estimate of variable consideration that's impacted by product returns, an expected value approach, which includes probability weighting, may be a more appropriate estimation method. The board decided that to provide useful information to users of financial statements, some estimates of variable consideration should not be included in the transaction price. This would be the case if the estimate of variable consideration is too uncertain and therefore may not faithfully depict the consideration to which the company will be entitled to in exchange for the goods or services. In that case, the board decided that a company should constrain the estimate of variable consideration that would be included in the transaction price. So with that, I'll hand it off to Christine for the discussion questions.
Thanks, Mary. We're interested in several questions regarding variable consideration. Since this is a major area of judgment within the standard, we're quite interested in how the application of judgment and the measurement of revenue impacts the decision usefulness and the comparability of the information for users. We're also interested in whether the information about out-of-period revenue adjustments is helping investors to understand changes in the estimates. Next slide. Thank you. We're also interested in whether those estimates of variable consideration are reliable and unbiased, or whether there's evidence of trends, either positive or negative trends in significant true-ups to the revenue amounts in certain circumstances. We're also interested in how companies operationally are arriving at those revenue variable consideration estimates, and how the application of judgment in the measurement of revenue impacts the cost of the standard for entities. And with that, I'll turn it back to Mary to talk about the next significant area.
Thanks, Christine. So the next area is about licensing. While much of the discussion around topic 606 is often framed around the 5 steps, it's important to note that there is implementation guidance included in the standard. The board decided to include implementation guidance to clarify how the principles in topic 606 should be applied, including on how those principles should be applied to features found in a number of typical contracts with customers. One of the areas that includes extensive implementation guidance is revenue recognition for licenses of intellectual property. Under prior GAAP, there was some licensing guidance by industry. For example, software, pharma, media companies did not all apply the same guidance. Under topic 606, the guidance applies to all licenses of IP. However, the new guidance includes some significant changes from the prior recognition guidance. For example, topic 606 includes a dual model whereby a company needs to assess whether it grants a functional license to IP, which is recognized at a point in time, or a symbolic license to IP that is recognized at a point in time or over time. Things like software licenses are typically functional IP, and things like trademarks or logos are symbolic IP. In addition to providing implementation guidance about timing of recognition, the standard also includes guidance on identifying performance obligations. For example, how you might figure out whether a license is one license of IP or you're granting multiple licenses of IP. And there also is an exception to how to apply the variable consideration guidance to sales or usage-based royalties. So with that, I'll hand it off to Christine for the next slide.
Thanks, Mary. So we have heard during outreach that some companies restructured their deals or their product offerings to favor over time reporting as opposed to upfront reporting. And so we would be interested in academic research that either supports or refutes that claim that we have heard anecdotally. We're also interested in whether there is evidence of modification of contract terms to achieve other reporting objectives, such as to accelerate revenue in some circumstances as well. And with that, I'll turn it back to Mary.
Okay, thanks, Christine. While we typically focus on the impacts of topic 606 on revenue, it's also important not to lose sight of other amendments that were made to the guidance that impact cost accounting. Specifically, a new subtopic, 340-40, was created with guidance on capitalizing costs to obtain a contract, such as commissions, and cost to fulfill a contract. A key change is that the guidance on cost to obtain a contract requires capitalization of these amounts, where prior guidance allows a policy election whether to expense or capitalize amounts. Capitalizing costs requires application of significant judgments, such as determining amortization periods and considering the effect of renewals. So with that, I'll pass it back to Christine.
Thanks, Mary. So in the area of capitalized costs, first of all, we're just interested in some descriptive data. What is the magnitude of the amounts that are being capitalized under Topic 606, the length of the amortization period, the extent to which these costs, capitalized amounts, are classified as current assets versus non-current assets. And then we're also very interested in how this information is or is not being used by investors. So have they adjusted their calculations of working capital, for example? Do they utilize the capitalized cost information in their models, or do they ignore that information? Those would all be questions that we would be interested in with respect to this change in the guidance. And then also just overall, is the new guidance resulting in outcomes that are perceived to be an improvement over the past approach, which allowed companies to undertake a policy election to either capitalize or expense? And with that, I think I'll transfer it back to Jeff.
Yeah, and I don't see any unanswered questions at this point, so I'm going to lateral it right over to Mary, who's going to take us through disclosures, and I think she's also going to cover transition as well.
That's right. Thanks, Jeff. In this next section, I'll provide an overview of the disclosure and transition requirements, and then Shannon will take us through some of the potential research opportunities. So moving to the disclosure slide, disclosures are an important part of the revenue standard. Under the prior guidance, there are few required revenue disclosures, so it can be difficult for users of the financial statements to understand a company's revenue in some cases. Yet revenue is often the starting point for analyzing a company. As Lucy had mentioned earlier, one of the board's goals for the Revenue Recognition Project was to provide users of financial statements with more useful information by specifying a more comprehensive and cohesive disclosure requirement. This slide summarizes those disclosure requirements. At the top, you can see the overarching objective of the disclosures. It's important to keep this objective in mind because the board did not intend the disclosure requirements to be treated as a minimum checklist of requirements, but rather it's an opportunity for the company to tell its story about its different sources of revenue and how it has applied the principles to its own particular lines of business and types of contracts. On this slide, I'll just highlight a few other points. First, the disaggregation of revenue is something users tell us is very important. The standard requires a company to disaggregate revenue into categories that depict how the nature, amount, timing, and uncertainty of revenue and cash flows are affected by economic factors. The standard includes some examples of the types of categories that may be appropriate, but the board intended companies to select the type of category or categories that would be useful to users for their specific circumstances and did not provide a specified list. Second, the standard requires disclosures about the amount of the transaction price allocated to remaining performance obligations. This disclosure aids users in developing their predictions of future cash flows. While similar to existing backlog disclosures, this new disclosure provides a common definition of a remaining performance obligation that can be applied by all companies. Additionally, it provides additional rigor around the disclosure because it captures those agreements that meet the definition of a contract, which was step 1 under Topic 606, and it would not capture cancelable orders. On the next slide on transition, there are 2 methods that were available to companies when initially applying the new guidance. Regardless of the method selected, investors will receive some comparative information. During the development of the standard, investors and other users inform the boards that comparative information is critical for revenue. Under the full retrospective method, a company recognizes revenue under the new standard from the beginning of the earliest comparative period provided. In other words, when an investor looks at the P&L in the year of initial application, the information for all years presented will be under the new revenue guidance. Under the modified retrospective method, a company recognizes the cumulative effect of initially applying the new standard as an adjustment to the opening balance of retained earnings in the annual reporting period that includes the date of initial application. Under this transition method, the comparative periods would not be restated. Therefore, when an investor looks at the P&L in the year of initial application, the current year is under the new guidance, and any prior years will be under the old guidance. However, under this approach, a company is required to disclose in the footnotes what the current period figures would have looked like under previous revenue guidance. This disclosure should allow investors to evaluate the trends using comparable information. And with that, I'll hand it off to Shannon.
Thanks, Mary. So as we look at disclosures, we'll see that most of our questions kind of fall into this initial bucket of whether decision useful information is being reported to and used by users of the financial statements. And so first and foremost, we just want to know whether the required disclosures are achieving the disclosure objective. So Mary highlighted that on her first slide as providing users with information about the nature, amount, timing, and uncertainty of figures on the financial statements. And so are those required disclosures helping us to reach this disclosure objective? And then we also talked a little bit about some qualitative and quantitative disclosures that exist. And so with our qualitative disclosures, we'd like to know, are they conveying decision useful information? And further, are these disclosures informative or are they boilerplate? And then similarly with our quantitative disclosures, are they also conveying decision useful information? Next, again, because there is a sufficient amount of judgment in the process, we'd like to know whether the disclosures are allowing users to understand the application of management judgment in revenue recognition. Then again, as Christine outlined earlier in the presentation, the PIR process is ongoing so that we can think about changes that should be made to the standard as we move forward. So with that in mind, we'd like to know whether there are any disclosures that could be removed or potentially if there are disclosures that should be added that would provide users with additional decision useful information. And then last, again, in line with the objective of the standard, are the disclosures that are being used improving the comparability of revenue information across entities? Then talking a little bit about a few more specific items. So Mary talked some about disaggregation and how there's substantial flexibility in disaggregation. And so we'd like to know, are there systematic differences in the level of disaggregation that are presented in disclosures? And does this disaggregation convey decision useful information? Given that sufficient flexibility, are we still seeing decision useful information reaching users of the financial statements? Along with this, we'd like to know whether certain industries disaggregate more than others. So are there systematic differences in terms of the categories that are being used within industries? And is there comparability between companies in the same industry and the number or types of levels that they disaggregate to? Mary also talked a little bit about transition and about companies' choice between a full or modified retrospective transition. And so we have a few questions on this point as well. The first is just, were there systematic differences in the companies that chose a full retrospective transition versus those that chose a modified retrospective transition? And then following on with that, we'd like to know whether or not those differences provided any change in transparency. So specifically, did the use of a full retrospective transition provide greater transparency and less disruption in trends? And did users respond favorably to those companies that chose to go through the extra effort to employ a full retrospective transition? And then last is the standard operational. What is the level of compliance with the disclosure requirements, and does compliance vary across entities in a specific manner? And this is informative to us at the FASB because it helps us to understand whether the standard is in fact operational. If we see consistently that there is not compliance in one area, that might highlight to us that additional guidance might be necessary to help improve compliance with the standard. And then our last slide talks specifically about the remaining performance obligations, or RPOs, which Mary touched on. And I don't know that we got too much into the details about the exemptions that were offered to companies related to disclosures for RPOs, but we would like to know, in light of these exemptions, how many companies are providing RPO disclosures? And more specifically, how many companies have 100% of their revenue exempt from disclosure under these exemptions? Or for those companies that are providing the disclosure, what proportion of their revenue is either included or excluded in the disclosure under these exemptions? For those who do report RPO, are they voluntarily disaggregating? And if so, what categories of disaggregation are being used? And then last, how do companies present the information about when the entity expects to recognize the amounts as revenue? For example, what types of time bands are being used when companies provide this information? And with that, I think we will pause for Q&A.
Yeah, so I think we have a couple of questions, one of which Mary wants to answer.
Thanks, Jeff. So the question is, did the board have any expectations on whether the disaggregation of revenue under 606 would differ from a company's disaggregation approach according to segment disclosure requirements? So on this one, the disaggregation of revenue objective and requirements is different from the segment reporting, which uses a chief operating decision maker approach. But I think there are cases that we've seen where the disaggregated revenue, could be the same as the segment level. And sometimes it's not the same. It really depends on how the company is looking at that overall disaggregation objective and how they're going to meet the disclosure requirement. There is a requirement in the revenue disclosures, though, that you I don't think it's reconciled to the segment, but I think it's something along the lines of like explain how the segments relate to the disaggregation. So there is like a little bit of a bridge there between the two.
Terrific. Lucy, I know there's a question you want to answer.
Yes, the question I have here is, did the board focus on or prioritize the needs of a particular user group, such as investors or creditors, in developing disclosure requirements? So from a general perspective, like the purpose of financial reporting is to serve the need of all investors, creditors, and other users that will use the financial information to make the capital allocation decision. So I would say the board does not have a preference or specific prioritization ranking to serve certain needs of the investors. We, during the initial deliberation and re-deliberation of the revenue standard and the other standards, and during our outreach in the PIR process with the users, we reach out to all different kinds of users that will use the information for their financial capital allocation decision or analysis.
Thanks, Lucy. I don't see any other unanswered questions, so I'm going to turn this over to Shannon, who's going to talk about educational opportunities and materials.
Thanks, Jeff. If we head to the next slide. We wanted to highlight again our other webinars. So last week we had, or 2 weeks ago actually, we had our webinar on topic 842 for leases. And the recording and slides for that are both available on our academic landing page in the same spot where you were able to find the slides for today. And we will also post a recording of today's webinar in that same spot, hopefully later today or certainly early next week sometime. And then next week on March 26th, so a week from today, we have our final webinar in this series, which is on topic 326, financial instruments, credit losses, or the more commonly heard CECL. And we'll be covering, again, similar high-level overview of the standard and some related areas for research, as well as some specific topic areas and related areas for research there. And then we'll also be having in July a webinar on XBRL data, which I'll talk a little bit more about on the next slide. But if you're interested, again, in registering for next week's webinar or seeing the recording from the leases webinar, you can head to our academic landing page to register there. And we'll continue to post information related to the upcoming XBRL webinar in that same spot in the future. In terms of our July webinar on XBRL, it will be XBRL and academic research, a workshop on how to pull XBRL data. And we are very fortunate to have Beth Blankespoor from the University of Washington, who will be working with us to present this webinar. And she'll provide an overview of how to pull XBRL data that could be useful in conducting research, specifically on the revenue standard. So her examples will focus on XBRL data that pertains to revenue, but should have broad applicability in terms of the tools that you will use to pull data for other standards. And in terms of why this might be of interest to you, we know that there's a 1-year lag at times for data through CompuStat. And so XBRL data actually gives you the flexibility to pull real-time access to the most recent corporate filings. And so as you think about submitting to the Accounting for an Ever-Changing World conference, we know how valuable that extra 1 year of data might be. And so we wanted to provide some training to allow you to use XBRL data in your research projects for that conference. If you're interested in learning more about XBRL right now, we actually have a recording from the 2021 AAA FARS mid-year meeting posted on our academic landing page where Beth gave a similar training, and you can start there to kind of build some of your skill set and then stay tuned and register for our July webinar to hear even more. And then here we've just kind of provided a summary of all of the links that we've provided throughout the webcast today. So we have a link to the conference webpage, specifically to the Topic 606 implementation webpage, and separately the FASB post-implementation review or PIR webpage, and then also a link to our academic landing page. And as I mentioned, the academic landing page is kind of the one-stop shop for all of the resources related to our webinar series here. So the PowerPoint slides and recordings are available. We have a current XBRL training video. We'll have webinar registration for our CECL webinar is open now, and we'll have that same registration link later this year for the XBRL training session. And then last, we've just included the FASB Academic Fellow email, which is academics@fasb.org. So if you send an email there now with any questions related to the topics that were covered today, or really anything else, all things academic, I'm happy to answer. And that email address is good moving forward as well. So for those of you who are familiar with the postdoctoral fellow position, it is a one-year role. So if you have a question 7 or 8 months from now and you know I'm no longer with us, that email address is still a great one to use, and that will reach our current postdoctoral fellow.
Anyway,
and with that, we will just leave it open to any last minute questions.
So are there any last minute questions? Maybe we'll just wait a minute or so, and before I turn to Christine to give some closing comments.
We don't see, does not appear to, oh, one just popped up.
Awesome.
Go ahead, Jeff.
Let me just see what it is. See if who wants to answer this one.
I'm happy to provide one perspective on this, and then if anybody else wants to jump in. So the question, if I can find it, it just disappeared on me there. It says, can you speak to how the board thinks about disaggregation? It was mentioned that investors want more, but are there any concerns that encouraging or requiring greater disaggregation could lead to firms disaggregating items that don't have different implications for valuation or contracting? So from a big picture perspective, and this is just speaking from the experience that I've had since joining the board in 2016 in working on our projects on trying to improve segment reporting, so the extent of disaggregation and segment reporting. And then we also have had a project on our agenda that was looking to improve the amount of disaggregation of information on the consolidated income statement. I would have to say that it's more of an issue that companies generally do not want to provide more disaggregation. And it's quite a struggle to write standards that generate a greater level of disaggregation of information. So I think as a board member, my concern is more on are investors getting a sufficient level of disaggregation? I think we have a long way to go before we would get to the point where the disaggregation is so fine that we would need to worry about investors getting confused by the information or misinterpreting the information. Does anybody else want to add anything to that?
I was just going to add, Christine, that I think, when we've looked at actual disclosures under 606, we haven't observed any kind of over disaggregation. I think to your point, companies tend to lean on the side of less levels than more. And I think it'll be interesting to see how that evolves over time. But for now, I don't think we've observed that in filing.
One thing I'd like to add is on our disclosure framework, we do have the concept of materiality. So I think for any immaterial information that does not have the implication or valuation purpose, it might be passed out. So I think it's a balance.
So we have a couple of other questions. Maybe someone could address the second question first about the transition resource group.
Sure, I could take that one, Jeff. The question was, if I understand it correctly, there is a separate transition resource group for US GAAP and IFRS. or the questions that the two TRGs getting very different. So to clarify that the transition resource group was done jointly with the FASB and the IASB. We kicked that off in 2014, right when the standard was issued, and held those jointly. What the submitter might be referring to is we continued with the TRG 1 year longer than the IASB did, and part of that is because we have a little bit of longer tail on the effective dates. We had the effective date deferral, and then we have private companies, just coming effective this year, which IFRS does not have that same delay. So, we dealt with those questions jointly, and then even when we continued that additional year, we shared all of that input with the IASB and got their input on issues as we were having those discussions. So hopefully that clarifies that point.
Okay. And I think we have one other question actually by the questioner who I think just left for class, but I think we could perhaps answer it anyway, right, Lucy?
Yeah, so this question is about have more access to the, my understanding should be the FASB board memos that includes a discussion on those changes, and also the feedback we received on the discussion paper or ED comment letter or surveys. So there's a difference between the FASB process and IASB's process, because before our board meeting, we will post the board meeting handout, but we usually do not post the board memos. That is different from the practice of IASB, but we do have the comment letters and the on the EDs and the TRG discussion on all the revenue related issues on our implementation website. So we can work with Shannon to see what other information we can post for the easy link for the academic purpose.
Yeah, and I'll just add, we do have some work going on in the background trying to aggregate some information that might be of use to academics, and hopefully we'll post that. We'll send out a follow-up email after our entire webinar series is complete, and so hopefully at that point in time, we'll have an update in terms of what those resources might look like and where they'll be available on our website.
Thanks. And we do have one other, I guess, request from an attendee that I'm not sure, based on Christine, your opening remarks, I don't know if we want to answer this one. You feel free to just mention what they're asking us to do.
Sure. So the question is there a top 3 super important research questions that you're interested in? What would be your top 3? That is a really difficult question to answer, because there's so many aspects of the revenue guidance that we're interested in understanding what the impact of the guidance has been. So I would just put it maybe for myself into 3 big buckets. I mean, clearly research that helps us to understand whether the guidance achieved its objectives or not. So is it providing more decision useful information to investors, however you might want to assess the improvement or not in decision usefulness of information? That is, I think, a critically important thing for us to understand. I think any research that helps us to understand whether there were unintended consequences, whether there were changes in contracting, changes operationally, changes in audit procedures, any sort of impacts of the standard in ways that we may not have anticipated at the time that the standard was issued, I think is another big area that research will help us to understand. And then last but not least, I would encourage anyone who does research in this area to not go light on the descriptive statistics in your studies if you're submitting them for the conference. Very often those descriptive statistics can be very, very interesting to us to just help us to understand the overall landscape of what is happening out there. And so as you're doing research, if you have interesting ways of cutting the data to provide more insight into your descriptive statistics, we'd be very interested in that as well. But again, I think that there are a lot of areas in here to conduct research, and we will be most interested in all of that research that you're undertaking.
And if I could just add, we're interested in research on all topical areas and all methodologies as well. I know we've received some questions kind of broadly about that, and that is absolutely the case. I know the staff work tirelessly to do outreach with not just preparers, not just users, but auditors as well, kind of all stakeholders throughout the process. And so we're interested in research that can kind of validate or highlight new things that pertain to all of those stakeholder groups. And similarly, throughout the process, the staff rely on research that is archival, experimental, and analytical in nature. And so we're very interested in all three research methodologies as well.
Lucy, it looks like there's a question that you'd like to answer.
Yeah, this question is about, in terms of responses, question comments from users, have you noticed any substantial differences across user groups, such as equity or creditor investors? From my own observations, the substantial difference I do not note in like that type of the user groups. The difference I noted is between like some generalist, like the investor cover like the generalist investors and some special investors. They might have like different like insights or different in-depth like depth to understand the revenue standard. I see the difference there from my observation. Also, another is the specific industry they're focusing on. I see if the investor is focusing on the healthcare or some other software license industry, their comments is more like when they observe the difference under the new GAAP and the 606 and 605, they have more a different perspective from the other investors. It's more from that perspective, not by their like general group, like all the equity investors or the creditors.
And if I could just add something there, and I'm going to ask Lucy to, or Mary to confirm or dispute what I'm about to say, but I think one of the things that we have heard from some investors, particularly those that follow entities that are involved in licensing arrangements, that if there is a mixture of overtime and upfront revenue recognition going on within that entity, we have heard from some investors that they have difficulty in some cases, depending on the disclosures that are being provided, distinguishing how much of the revenue is upfront recognition versus how much of the revenue is overtime recognition, and that can challenge them when it comes to forecasting future revenue. Is that a fair statement, Mary or Lucy?
Yeah, I think so. I think if you think about investors and they're trying to predict cash flows, if you've got, some being overtime and some being some overtime and some point in time, it's harder to predict if you don't know that split. And I would just mention that the disaggregated revenue has timing of recognition as an example of a disclosure, but it's not a required category for disclosure. So some companies do provide those splits, but some don't, as it's not required.
And also with the changing of their business models, they're at another layer of complexity.
And I would just add that another related issue that may be operating in the background was around the same time there was a change in the accounting for cloud computing arrangements and the treatment of the cost of implementing a cloud computing arrangement. And so that may also have impacted some of these changes, if there were in fact changes, moving from licensing to software as a service type movement. So do be aware that there are other things that we're changing at the same time that you may need to be taking into consideration in your research design.
Okay, I don't see any other questions, so maybe I'll turn it to Christine now for some closing comments.
Thanks a lot, Jeff. Well, we greatly appreciate all of you joining us today. We know that you're very busy individuals, but we really do hope that you found this session useful, that it'll spark some ideas or give you confidence in ideas that you're already working on. And please, if you do run into any questions along the way, or if there's anything that we can do to help you do your jobs more effectively, do reach out to academics@fasb.org. that is there to act as a liaison between the academic community and our organization, and we would be very gratified if you took advantage of it. Guess with that, I'll just sign off, Jeff.
Yeah.
Yes? All right. Thank
Hope
you,
all
everybody.
Stay safe and well.
Have a
Bye-bye.
good day.